Hi, today I'm going to talk about the Maersk stock valuation. Maersk is a global container shipping company. If you don't know what container shipping is, you can see from the picture, this box is called container. And when companies such as Amazon, they want to mail product from overseas to US, they will put those products in the container so that they can be shipped through the boat. Container shipping is very important in the global trade and is comprised about 60%. My interest in Maersk and global shipping originated during the COVID because in COVID, most people stay at home and they depend on delivery. If you see the picture, you can also tell that the container shipping has been much more volatile ever since COVID. This picture from Statistica shows the top global container shipping company. And the reason why I choose Maersk is other companies are either not public traded companies, which means you cannot buy their stock, or they are not traded in the US market, and I mainly invest in the US. This picture shows Maersk stock price changes. It's understandable that the stock has been skyrocketed during the COVID and have been decreased after that. I bought the stocks in 2021. In 2021, like most people, I know few about investment, and I bought stock based on a simple idea. I think this is COVID, people stay at home, and the global shipping will boom. Just like the people who buy NVIDIA because they think there's a great future in AI. But the thing is, first, when you see a great future, when you see a business will make money, everyone else also know it. And when that happens, the market price may have already priced in this expectation. The second is that the business with great future still can be overvalued, and the companies that are declining can still be undervalued. So for the Maersk, when I think about the container shipping in 2021, is everyone else have already know that. So I bought it at a high. I still have positive capital gain in Maersk, and I will explain later. Ever since I really know how to invest in 2023, I made myself a rule. I will never trade any stocks until I finish valuation. And for those stocks that I bought before 2023, I will not trade them until I finish their valuation, even if I may miss some opportunities to sell them at high earlier. I want to use this method as a way to build my investment discipline. This is the schedule for this analysis. First, I will explain the Mars business model, and I will explain how to deal with stocks with different class of shares. Some stocks they have class A and B or ABC shares, whether those shares have the same value, and what changes you need to make if you want to buy one of them. After that, I will teach you how to estimate the cost of pension funds. For many old companies like Maersk, like JE, usually have a large chunk of pension fund, which means when their old employees retire, they need to pay their retirement income. And because when you buy the stock, you are buying a piece of the company, but you get paid after everyone else. The more the company pay for others, the more the company spend on the pension fund, the less you will receive. So I will explain how to estimate the pension fund liability. And at the end, I will tell you how to estimate Maersk future revenue and profit, and whether the stock is overvalued or undervalued at this point. This picture from Maersk 2024 annual report shows different business segments. Maersk mainly has three business segments: logistics, container shipping, ocean container shipping, and terminals. The container shipping, as I mentioned earlier, are mainly ocean shipping for the products in these containers. And the logistics solution means the process from when the product is produced until the product delivered to the hands of the customers. For example, after the product out of manufacturing, they need to put in the warehouse between they are sold. And it is the logistics solutions responsibility to figure out how to make most use of the warehouse to save the cost to store as much product as possible. But you also don't want to make your product stay in the warehouse for too long. And also after here we have terminals. Terminals is just a place before or after the product is shipped by the containers. So if, say, Amazon receives some product from overseas through the boat, and when the boat arrived at the terminals, they either directly transferred to the ground delivery, like UPS, FedEx, or they will stay in the terminals. There will be a cost, and it is the logistics solutions responsibility to figure out how to find a balance between make the product stay idle on the terminal or ship through the ground shipping. And the third is the terminals. Maersk also owns some terminals, and this is their new business line. After you know the business model, you will think about how the company make money based on the business model. And for Maersk, since its revenue is mainly count on the container shipping, the global shipping, I believe that the Maersk growth driver are future global container shipping volume, which means how many product they will ship in the future, and also future container shipping freight rate, which means how much they can charge for each delivery. But before talk about that, I would like to talk a little bit about voting and non-voting share. Every time when you value a stock, you value the value of the total company, subtract the debt, and you divide it by total shares to reach a price per share to determine whether you should buy or sell the stocks. So it is very important to make sure that you get the correct stock shares. Otherwise, you can get all other estimation correct, but still be wrong if you mess up with the voting shares. And most of companies, they only have one class of shares. Determine the shares is a slam dunk. You just use the total value divided by the shares. But for some company like Google, Meta, previous Facebook, or Musk, they have two class of shares. And you need to determine whether these two class of shares carry the same value. Usually they have voting and non-voting shares. Voting shares means if you have the voting shares, you can make decision in the company's management. For example, if the company want to open a new business line in the Asia, and you have the majority voting shares, you can you can choose to agree or disagree decision. However, if you have non-voting shares, you cannot change what the management want to do. And that will have a huge implication. I remember that 2 or 3 years ago, Meta, previous Facebook stock, decreased to the historical low at around $100. The reason is that the CEO of Facebook, Mark Zuckerberg, decided to spend a huge amount of money on the metaverse, on the reality lab, the VR headset. But most people, investors, including me, don't think that will return money. However, people cannot change the decision because Meta stock has two class of shares. The Class B shares is mainly owned by the Mark Zuckerberg and other management, and it carries voting right. The Class A shares, the shares that are traded on the Nasdaq, does not carry any voting shares. If you buy Meta stocks publicly and you don't like how Mark Zuckerberg run the business, you cannot change anything because you don't have voting shares. Because of that, there will be a difference between the value of voting shares and non-voting shares. And in this graph, I just showed several scenarios and factors affecting value of shares and voting shares and non-voting shares. First, whether the company is well management. If the company has been consistently make great investment, have been consistently generate high positive returns like Apple and Google. Think about that. Do you think there will be large difference between voting shares and non-voting shares? The difference will be small, right? Because regardless of you have voting or non-voting shares, the managers there have the ability to make great decisions in the future. So you don't have to make any changes. If the company is well management, the difference between voting and non-voting share will be low. However, if it's a poorly management, the things will be very different. I'll give you a simple example. Suppose a company have 1 billion cash on the balance sheet, and the company has been losing money every year. So they sell the product, but they lose money every year. But they have 1 billion cash on hand. They also have 500 million debt. But the stock right now, the market capitalization is traded at 200 million. If you are an active investor like Bill Icahn, what can you do? It's very easy. You can buy the company. You can buy the company at 200 million dollars and just sell it because it have 1 billion on cash on hand, 500 million debt. So if you buy at 200 million, you can shut down the business, pay off all the debt. You still earn 1 billion, subtract 500 million and subtract 200 million you pay. So you still make 100 millions. So because you bought the voting shares, and if you are a majority holders, you have the ability to decide how the business is run. And that's why the voting shares are the premium over the non-voting shares. However, if the company management have a very low probability of change, the difference between voting and non-voting shares will be very small. Just think about many home business like Tata Motor, Estee Lauder, Adidas, also the Maersk, the company I value. They mainly owned by the family business, and usually that family is also the founder of the business. If you buy such a company, even if you have the voting shares, how likely do you think you can change the management? It's almost impossible, right? Not let alone the public company. My family have business, and I will tell you, every time if I want to make some change to the business, but my idea, my opinion is different from others, it's almost impossible to change it because there's a peer pressure from the family. So when you value the company, if they have two shares, you need to decide whether the company in voting shares has large probability and necessity to change the management to decide whether to give a premium for the voting shares. But for the Maersk, since the company is family owned, I just directly divided by the value estimate by the total voting share plus non-voting shares. However, if your company has room to changes, you need to estimate the premium for the voting share. And the method is first, you will see how much the company worth right now. So if you don't make any changes, how much the company worth right now. And then you get something called optimal value, which means if you make all necessary changes, like it could be cut off some losing money segment or spin off some segment, reduce the cost, improve the efficiency, and you see if you make those changes, how much the company worth. That's called the optimal value. And you use the optimal value, subtract the current value. You can know how much more the company will worth if you change the management. And use that multiplied by how likely the company will change. And after that, you use that divided by the voting share, you can know how much the voting share worth compared to the non-voting share. After talking about the different class of shares, I will talk about the pension fund liability. There are two different types of pension fund. One is called defined contribution plan, another is called defined benefit plan. They are all for the employee's retirement. In a defined contribution plan, the employee decide to contribute a certain amount of their income every month, and the company will match. For example, if an employee makes $5,000 a month and they decide to contribute 1,000 of their 5,000 to their uh, retirement, and the employers will match by also contribute by 1,000. Because this kind of pension plan is based on employee voluntary actions, we consider it as an operating expense because it is unlikely for employees and it's also not allowed for employees to contribute more than their salaries. In contrast, in the defined benefit plan, the employee doesn't need to contribute any money. Instead, the employers promise its employee to pay them a specific amount of money after they retire. And to achieve that, the employer need to invest some money in financial assets such as stocks, government and corporate bond, real estate. They need to invest in those financial assets when the employees are still working for the company. And after they retire, company will use the return from those financial assets to pay employees retirement income in the future. However, if the return from those financial assets investment is not enough to cover employees' retirement income, then the company need to put extra money into the fund. Because as an equity investor, you receive money after everyone else. The more the company spend on the pension fund, the less you will receive as an equity investor. So it's very important to analyze pension fund obligation if the company have any. Most young company right now have been using defined contribution plan, and you don't need to worry about that. But for old companies such as GE, 3M, and also Maersk, I'm valuing right now, they have defined benefit plan. In this graph, I collect information from Maersk financial report for the past 10 years. And you probably see there are different terminologies you don't know, but just bear with me. First, we have the pension asset. A pension asset are those financial assets that the company have been investing, like stock, bond, real estate. Usually, what is happen is they will invest in this stock and bond, and in the future they will have a return. Like for example, if the stock have appreciation, they can sell the stock, and for the bond, they have the coupon payment, so the lump sum payment during the maturity. This is how much pension asset they have each year, and this pension obligation means how much money they need to pay their employees. As you can see, for the most of time, Maersk pension fund is in underfunded status, which means the pension asset they have is not enough to pay off employees' future retirement benefit. So they need to contribute more money in it. And this contribution by year means how much money the Maersk has been put on it. And here we also have the plan average duration. This means how many years they expect those employees will receive retirement income. Usually, when a company have the pension asset and the pension obligation, what I will do is I will see the structure of their pension asset because usually company will disclose, say they will have 50% US equity, 20% global equity, 10% corporate bond. They usually will disclose that. What I will usually do is I will use the historical return rate for different assets, for stock, for bond, and I estimate the return for those investment. And I will see how much their pension asset can grow if they achieve those return rate and compare with the pension fund obligation. If the pension asset in the future is still lower than the pension obligation, I will subtract the difference from the operating asset. That's what I usually do. But Mars has already ceased its pension defined benefit plan to new employees, which means they only need to pay retirement income for those older employees in the past. If you see the plan average duration, you can also see that it has been decreasing, which means after these current old retired employees pass away, the company will not have new obligation. So I just take some card. I take the median of how many millions dollars the company will contribute, and I just subtract them 10 years. By doing so, I assume that the company will keep contribute about $27 means every years. But after 10 years, they will stop to contribute because they probably have already paid off all the old employees who still have the defined benefit plans. But other than that, there is another very important adjustment you need to make about pension plan. Here, I just show you how the operating income, how much money the company earned, has been calculated. Usually, how accounting report is they will first report sales revenue, how much product they sell, less the reported operating expense like G&A, general and administration, the raw material, the marketing expense, etc. And they will get pre-tax operating income, and they will pay the tax. You get after-tax operating income. However, what happens for Maersk is I found that the accountant included the pension contribution, included how much the company put in the pension fund to the operating cost. Well, it is okay to do that with the defined contribution plan because usually if an employee contribute 1,000 this year, he or she is also very likely to contribute 1,000 every month next year. However, when you're doing that with a defined benefit plan, you assume that the company will contribute to the plan forever. But as we can see that the company has ceased the pension benefit plan to new employees right now, and they only have about 10 years to contribute, it's not reasonable to include that in the opening cost and assume that it will happen forever. So this is the adjustment usually I will make. In the sales revenue, in the reported operating cost, I will add back pension contribution. After I add back the contribution, I will subtract independently before the operating income, like I did here. But your question is maybe if I exclude here and I subtract here, the pre-tax operating income will be the same as accountant, right? But the thing is, it will have a huge implication when you estimate future operating margin. Operating margin means for each dollar of sale, how much money the company can earn. For the Maersk, they have a small number, but if the company have a large number, like $100 million of pension contribution here, if you do not exclude that here, you will underestimate future operating margin, so that you will underestimate future operating income and the company value. So it's very important to make such adjustment. But for Maersk, at this point, we only need to subtract this amount every year, and we add back the contributions to the reported operating margin here. After we did the pension plan, I will explain how to estimate the Maersk future revenue, profit, and stock price. Recall that here I mentioned that the Maersk growth driver will be future global container shipping volume and future container shipping freight rate. So my first step is I found the information from the tradingeconomics.com. That's a free website. They have information about the containerized freight index every year. And while what happened doesn't predict in the future, instead of using the index, I use the growth rate. I just compare this year and last year. Like for example, I will compare 2023 to 2024. I calculate how many growth rate in the container freight index every year. And here I also summarize data before and after the 2020 because the 2020 to 2022 is a special time. We are having COVID, we have lockdown. If I use that data to estimate the future shipping volume, I may overestimate the company's growth. Here we have the mean. This is average. Before 2020 is about 7%, while the average include years after 2020 is 23. And here we also have a SDDV, standard deviation. Standard deviation means how much each data in a sample averagely different from the average. So suppose you have a sample to calculate how much income people earn in a neighborhood, and the average is about we say $50,000 a year. However, in this community, there will be someone probably make $100,000. There also will be someone make only 10,000 or $20,000. So if you only use the average, so it will not so very representative. While the standard deviation just check the difference for each data sample from the average. And if you can say, you can tell that the data before the 2020 had a much lower standard deviation than the data after the 2020. And that makes sense because the global trade and the container shipping has been much more volatile after the 2020. But here I have the distribution. The good thing about stocks, about statistic is I don't have to get a specific number. I can run a distribution, and later I will choose to buy the stocks where most data has fall into, and I will explain that later. But the container shipping index only answer my question regarding global container shipping volume, but it doesn't answer my question for the container shipping freight rate, which is how much money the Maersk can charge supplier to ship their product. And also, by common sense, you can know that usually when the more the shipping volume is, the more crowded the transportation is, the shipping rate will also be higher. So I also need to consider the effects of shipping freight rate. What is very good about Maersk annual report is the company gives us some sensitivity guidance. The sensitivity guidance tells you how the company's performance, future revenue, and profit will react to the freight rate changes. And as you can see here, this data shows means for each 100 USD FFE, this is just a unit for the special unit for the container shipping. The company said for each 100 USD FFE changes, the company will make about 1.3 billion more or less dollars just because of free return change. So after I knowing that, I also run a distribution for the container shipping rate. And here you can see that the container shipping rate, the average is about 1,458, while the standard deviation exclude the 2020 is about 147, which means for each years in the past, they averagely have $147 difference from the median. And after I know the data, I can just use this data, divide it by 100 and multiply by this number. I can know that if the revenue growth is up and down, how much changes they can bring to Maersk operating income, their profit. And as you can see here, this is the company's revenue. I multiply by 1 plus revenue growth rate. I can get next year revenue. And then multiply the operating margin. I get estimated operating income. And I just can add the effects on operating income, the freight rate standard deviation divided by this one and multiply this one. I can add or subtract that amount from the operating income. But when after I do that, I found I encountered another challenge. I don't know if next year they will decrease or increase, right? Here we have the effects on EBIT for about $2,000 million. But the thing is, the company maybe have 2,000 decrease this year and increase this year, decrease this year, increase this year. They probably also can be decrease, increase, 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 decrease, decrease. So it's really hard to tell whether which year is increase or decrease. So how do I deal with that? My first tentative solution is a proof of exhaustion. Just as the name suggests, I just try a different scenario. So what I do is like, for example, I would say for year one, it have decrease, and year two, they have decrease. Oh, they have year one decrease, year two increase. While I was trying that, I found that if I want to do that, I need to have 3 power 10 scenario, and I'll be literally exhausted. And someone probably will say, oh, you can use AI. It's true that I can use AI, but you know what? It's not necessary. I don't know how to use that because in the stock valuation or maybe in life, It is always important to be generally correct rather than accurately wrong. And in the stocks, you don't make money by correctly make the prediction. You make money by being less wrong than others. So this is what I do. At first, I can try they have increased operating income for 5 years continually. So I just add this number for 5 years every year. I also add them for 10 years every year. And then I subtract for 5 years and I also subtract for 10 years. So by doing so, I can know that if the future container shipping is keep increasing or keep decreasing, how much the stock price worth per share. And this is my distribution. You probably wonder how do I got this number. If you remember here, I got a container shipping volume distribution. The average before the COVID is about 7%. The average include the COVID is about 25%. And if you see the distribution, you can also tell that before the COVID, most of data fall to about 24%. And after include the COVID, most data fall into 7%. So what I do is I will try 7%, 11%. 11% is the industry average, 19% is the third quartile of the industry, and the 7% and 24% is the value I calculated from the distribution. And as we know, even for those the best company, they always have a growth period. After those growth period, they will gradually have decrease growth rate and even decline. So what I usually do is I will start with from the current growth rate and I gradually increase to those annual growth rate based on distribution and gradually decrease to the 10-year US government bond rate. By doing so, I expect that after year 10, the company will have generally a growth rate same to the GDP average growth rate. And here I have all those distribution based on different revenue growth rate, based on different freight rate. You probably also can find that here I give 6 times for the 7% and I also give 3 times for the 24%. Why? Because if you see the distribution, they appear more time in the sample. If I just include this data, the data will not representative because it's much more likely for the company to have 7 or 24% than have 11 or 19%. After I do all of them, I estimate that the median value per share is about $7.94. But when I do that, I feel a little bit uncertain or unsafe. I was like, it's probably not very reasonable if I assume that the company have a 10-year decrease or 10-year increase. That is too extreme. So I also try, what if I calculate the median for only those 5 years, like 5 years or all increase, failures, all decrease. So what's the median will be? And you can tell it's about 7.83%. The difference is very small. This is the power of the statistic and distribution. I will buy more if the stock decrease to about 7.8 to 7.9. And to decide how to sell the stock, I will sell about 14 to $22. How I calculate that? If you know a little bit about investment bank or traders, you know that they use a PE ratio. So what I do is like here I have operating income. After I get operating income, I will subtract the interest expense and subtract tax, and I use that divided by total share to get EPS, and then multiply the PE ratio. You can watch my last video about Lululemon to know about how to do that. So I will not spend more time to explain here. And recall that at the beginning I said I still make money right now. Why? The company have been keep giving dividend and my current value of stock plus the dividend still make me have around 15% gain. Which brings another question is how to factor the dividend in the investment. Dividend is just a way of the company to give out its value. So if the company make more money, they want to return some money to the investors, so they will give dividend. I used to always think about how to estimate how much dividend, but then I think I don't need. As long as I can estimate how much value of the total asset the company have, and then it doesn't matter. It's just based on the company's choice to give or not give dividend. So this is my valuation for Maersk. Thank you for listening, and feel free to ask your question in the comment. Thank you.